and the discount rate. Step number one, we've got to understand how money works. It starts here with the government spending. They need to spend, spend, spend. And to spend, they have to issue a treasury bond. Primary dealer, which is a designated bank from the Federal Reserve, they buy these bonds and then they sell them to the Fed. The Fed prints money, and that's how they buy the bond. That printed money goes to the government. The government spends, spends, spends like we know they do. And this money goes to everyone that the government pays. They deposit that in the banks. The banks lend that out to all these normal people just like you and I, and that's how money's created. Step number two. Let's figure out the Fed funds rate. Let me be clear, this is the old school Fed funds rate. They don't do it this way anymore, but it's really important that you understand this. This is how they controlled the Fed funds rate prior to the great financial crisis. We've got the Federal Reserve right here, and let's say the current Fed funds rate is 5%. That means that the overnight lending between all of these banks, the interbank lending, they're lending to each other at 5%. Well, the Fed says, well, we want to increase debt in the system, and we want to increase demand and consumption. So we know that these banks are going to loan more money, or there's going to be more demand for debt if we lower this rate to 4%. So what the Fed does is they print money, they buy T-bills, normally under 1 year in duration. And the people who sell those T-bills take that money that the Fed printed, they deposit it into the banks. That means the banks have a larger supply of money. And if there's a larger supply of money, then that means that the price of money goes down. That's what drove the interest rate from 5% down to 4%. Step number three. The new way that they manipulate the Fed funds rate, this is the new school post-financial crisis. And now we've introduced QE, quantitative easing. So what quantitative easing is, the Fed prints money, they go into the market, and instead of buying short-term debt, they buy long-term debt because they want to bring that interest rate down to promote more borrowing from the standpoint of maybe mortgages or something that's more tied to the long end of the yield curve. So it's just supply and demand. They'll print this money, they'll buy these bonds, and that will bring the interest rate from 10% down to 8%. The problem with that is they inject so much new money into the system, so much money is printed, that would bring down the Fed funds rate way below where they wanted it. It would bring it down to zero, potentially even negative. So if they want the Fed funds rate at 4%, they've got to do something about that. So the scheme that they came up with is they said, well, we'll just go ahead and pay the banks interest on reserves or interest on excess reserves. So if you hear the term IOR or IOER, that's what it's referring to. So the Fed says if we just pay the banks 4% to hold their reserves with us, that'll keep the Fed funds rate from going any lower than 4%. Because the banks aren't going to lend out at 3% or 2% or 1% when they could just have that money sit at the Fed and collect 4%. So basically what they do is they create a floor to the actual Fed funds rate. But there's one more problem. You've got all these financial institutions that are outside of the Fed's umbrella. So you've got the normal banks in here. They're kind of the cool kids that are in the system. But you've got all these guys out here that are outside of that system, and they could come in and say, hey, if these banks won't lend you for anything under 4%, we will, because we can't keep our money with the Fed. We're not part of the cool kids, so we can't get the interest on reserves. So we'll come in here and we'll lend to you at 3.5%. or 2% or under that rate. That's the big problem with the Fed. So what they came up with, in addition to IOR, is reverse repurchases or reverse repos. And now we're getting to the modern day here. And you guys, I'm sure, recognize that term. So the Fed says to these banks that are outside of the system, we'll buy your reserves for that 4%, this reverse repurchase, and then you can buy them back from us whenever you'd like. The Fed effectively controls the entire market then to make sure that the Fed funds rate never goes under their target, even though they're pumping massive amounts of liquidity into the system by buying long-term bonds, which otherwise would have brought the Fed funds rate down way lower than they wanted it to go. Step number 4, the discount rate. So the Fed funds target rate right now, let's say, is 4%. And we have all the cool kids down here. They're lending to each other overnight in the interbank lending. But let's say there's an extra bank, Bank D, and he's part of the cool kids, but his balance sheet is getting really, really bad. He's done some terrible things, and he's about to go bust, or he's got some really, really problems. He might not stay in business. So the cool kids, or the other cool kids, they don't want to lend to him because they're afraid they're not going to get their money back. But the Fed, as we know, is the lender of last resort. So what they have is the discount rate. And this is a rate above the Fed funds. Let's say this is 5% right now, and this fluctuates with the Fed funds rate. But what that does is that allows the bank that's in trouble to go to the Fed. They kind of do the walk of shame here, and they go over to the Fed and they say, oh, Fed, we need all this liquidity and we're really running low and we got all these problems and none of the other banks will lend to us. We need this money from you. And the bank says, okay, but we're going to charge you a higher rate, 5% instead of the 4%. That is the discount rate. Step number 5, the repo market. This is a market where pretty much everybody can play. The cool kids can play in there. All these other financial institutions, they can play in here as well. And it's really just the banks lending to each other. One bank will get short on cash, they'll need it, they'll have some collateral like treasuries or mortgage-backed securities. And this bank, let's say they've got some extra money, they will go into the market and they will buy that collateral from the bank that needs the money. That bank will give them the collateral. And this is called a repurchase agreement. And it's done with a specific term, 1 to 14 days. And I've heard that they go as long as 1 to 2 months. So you may be saying, well, George, this sounds just like the Fed funds market where the banks are just doing this interbank lending. And it's true, but here technically they're not lending to one another. They're actually buying and selling with a specific term on that contract. Also, it's a market that financial institutions outside of these member banks can participate in. For more information on the repo market, check out this content right here, and I will see you on the next video.